Before we begin, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this presentation is not a substitute for professional advice tailored to your specific situation. Always consult with a qualified and licensed professional before making any financial decisions, especially regarding insurance coverage. Your individual needs and circumstances are unique, and what's right for one person may not be right for you. Sarah thought she'd won the lottery. She spent about an hour online, plugged her info into a few of those big-name quote comparison websites, and bam, a premium that was $150 less per month than her old policy. She clicked buy, did a little victory dance in her chair, and didn't think about it again. 6 weeks later, a distracted driver blew through a red light and T-boned her at an intersection. She was okay, thank God, but her car was completely totaled. And that's when the real nightmare began. Her amazing new policy, the one that was saving her all that money, it had the absolute bare minimum liability coverage required by her state. It had no collision coverage, no rental reimbursement, no uninsured motorist protection, nothing. The check she eventually got from the other driver's insurance company barely covered half of what she still owed on her car loan. Sarah saved $150 a month, but that decision ended up costing her $12,000 out of pocket, a mountain of debt, and her financial stability for the next 2 years. All because of a few unchecked boxes and a fundamental misunderstanding of what she was actually buying. Sarah's story is terrifyingly common, and it's not her fault. The online car insurance world is a minefield, specifically designed to get you to the checkout page as fast as possible. These websites aren't built to educate you. They're built to sell you. They use speed, convenience, and the allure of a low price to rush you through a decision that could literally make or break your financial life. They're playing a game of numbers, and if you don't know the rules, the house always wins. This video is your rulebook. It's your shield. Over the next few minutes, I'm going to walk you through the 5 most common, most expensive, and most devastating mistakes people make when getting car insurance quotes online. By the time we're done, you won't just know how to find a cheaper quote. You'll know how to find the right quote, the one that actually protects you, your family, and your future from a catastrophe like the one Sarah faced. We're going to turn you from a target into a savvy shopper who can't be fooled. So let's dive right into the biggest mistake of them all. The one that Sarah made. The one that millions of Americans make every single year. Mistake number 1. Equating the cheapest quote with the best value. When you go online to get a quote, what's the very first thing you see? It's a number. A big, bold, beautiful number. And every website is competing to show you the lowest one. Your brain is hardwired to see that low number and think, yes, I'm saving money. I'm winning. But what you're really winning is a lottery ticket to financial ruin. The cheapest policy is almost never the best value. In fact, it's often the worst. Here's why. That super low price is almost always based on one thing: state minimum liability coverage. Let's break this down, because this is the absolute foundation of your entire policy. Liability coverage doesn't protect you. It doesn't fix your car. It doesn't pay for your medical bills. Liability coverage is your financial bodyguard. It protects your assets, your savings account, your home, your future paychecks, from being taken away in a lawsuit if you cause an accident. It pays for the other person's car repairs and the other person's medical bills. Every state has a legal minimum amount of liability coverage you're required to carry. And the quote websites love to pre-select this option for you because it generates the lowest possible price. Here's the problem. These state minimums are dangerously, laughably low. They were often set decades ago and haven't kept up with the modern costs of cars and medical care. Let's use a real-world example. In some states, the minimum requirement for property damage liability, that's the part that pays to fix the other person's car, is just $10,000. $10,000. Now, take a second and mentally picture the cars around you on your daily commute. The average price of a new car in the United States today is over $48,000. You see Teslas, new Ford F-150s, BMWs, and luxury SUVs everywhere. If you cause an accident and so much as crumple the high-tech bumper on one of those vehicles, that $10,000 is gone in an instant. If the total damage is $40,000, and your cheap policy only covers $10,000, where do you think the other $30,000 comes from? Comes from you. The other driver's insurance company will sue you. They will get a judgment against you. They will garnish your wages, put a lien on your property, and drain your savings account. That cheap policy you bought to save $40 a month just became a $30,000 nightmare that will follow you for years. And that's just the car. What about the people inside? State minimums for bodily injury liability are just as terrifying. A common minimum is $25,000 per person. Does that sound like a lot? A single ambulance ride, an emergency room visit, and a few x-rays can easily exceed that amount. What if the person has a serious injury requiring surgery and months of physical therapy? We're talking hundreds of thousands of dollars in medical bills. If your policy only covers the first $25,000, you are personally on the hook for every single penny after that. This is the trap. The system is designed to show you a low price by selling you a policy that offers almost no real-world protection. It technically makes you legal to drive, but it does not make you safe from financial destruction. So what is the solution? What is the best value? The best value is finding the sweet spot where you have enough coverage to protect yourself from a realistic, modern-day accident, without overpaying for coverage you don't need. You must ignore the state minimums completely. A good starting point for most drivers, and what many financial experts recommend, is a policy with at least 100/300/100 liability limits. Let me translate that for you. That's $100,000 in bodily injury coverage per person, up to $300,000 total for everyone injured in the accident, and $100,000 in property damage coverage. With 100/300/100, you're protected in the vast majority of accidents. You can total a brand new Escalade and your insurance will cover it. You can be responsible for an accident with multiple injuries, and you have a substantial safety net to cover their medical care, protecting your own assets from a lawsuit. And here is the most important part, the secret the quote websites don't want you to know. The price difference between a useless state minimum policy and a genuinely protective 100/300/100 policy is shockingly small. Often we're talking about the price of a couple of cups of coffee a month. It is, without question, the single best and most cost-effective investment you can possibly make in your financial security. So, the first and biggest mistake is chasing that lowest number on the screen. It's a siren's call leading you straight to the rocks. You are not buying a price tag. You are buying a promise. A promise that if the worst day of your life happens on the road, a company will step in and shield you from financial ruin. Don't let a slick website trick you into buying a broken promise. But fixing your liability limits is only step one. There's another, even more subtle mistake that has nothing to do with the other driver. It has everything to do with your car and your body, and it's hidden in a single checkbox that most people don't even understand. It's the difference between getting a check for a new car after a wreck, or getting absolutely nothing at all. This brings us to the very first, and arguably the most devastating mistake people make when getting car insurance quotes online. Let's call it the gambler's fallacy. You see, the online quote form is designed to give you the lowest possible price to get you hooked. It presents you with options and it frames the most important coverages as, well, optional. The two biggest culprits are called collision and comprehensive. They often appear with little checkboxes next to them, and unchecking those boxes can slash your monthly premium in half. Feels like a secret hack. Feels like you're beating the system. But what you're actually doing is playing Russian roulette with your single biggest depreciating asset. Let me tell you about a guy named David. David was smart, financially savvy. He bought a beautiful 3-year-old certified pre-owned SUV. It was his pride and joy, and he paid $28,000 for it. When it came time for insurance, he went online. He put in his info, and the first quote came back at $190 a month. Ouch, he thought. But then he saw it. The little drop-down menu that broke down the costs. Liability, the part that's legally required, was only about $80. The other $110 was for something called collision and comprehensive coverage. Next to them, in parentheses, was the magic word, optional. David did the math. $110 a month is over $1,300 a year. He was a safe driver, never had an accident. In his mind, he thought, why would I pay for something that's optional? I'll just be careful. So he unchecked the boxes. His premium plummeted to $80 a month. He felt like a genius. He just saved himself over $1,000 a year. 6 months later, David was driving home from work on a Friday afternoon. The traffic slowed suddenly. The guy in front of him slammed on his brakes. David reacted quickly, but the roads were a little damp. He skidded just for a second and rear-ended the car in front of him. It wasn't a huge crash. The airbags didn't even go off. But the front of his beautiful SUV was crumpled. The hood was bent, the grille was smashed, one of the headlights was shattered. The police came, reports were filed. David was technically at fault. He called his insurance company, ready to start the claim. The agent was polite, took his information, and then asked a question that made David's blood run cold. "Okay, Mr. Johnson, I see you have liability coverage, so we'll take care of all the damages to the other driver's vehicle. Now for your SUV. Did you want to file this under your collision coverage?" David paused. "Yeah, of course." There was a long silence on the other end of the line. Then the agent said, "Sir, my records show you declined collision coverage when you purchased the policy." David's heart sank. He remembered that checkbox. He remembered feeling so smart. The agent explained that his $80 a month policy would pay the $7,000 to fix the other guy's bumper, but it would pay exactly zero to fix his own car. David got a few estimates. The repair bill for his SUV was over $9,000. He didn't have $9,000 sitting around. He still owed $24,000 on his car loan. So now he had a choice: drain his savings account, or drive around in a crumpled, broken-looking SUV that he was still making a $500 monthly payment on. He hadn't saved $1,300. He had cost himself $9,000, all to save $100 a month. He fell for the gambler's fallacy. This is not a rare story. It happens every single day. People don't understand what these coverages are. So let's break it down in the simplest terms possible. Your car insurance policy is really two separate policies in one. The first part is liability. This is the part the law requires. Liability coverage pays for damage you do to other people and other people's property. It never ever pays to fix your car or your body. It is purely for your legal and financial protection in case you hurt someone else. The second part of the policy is the part that protects your car. This is collision and comprehensive. They are almost always sold together, and they are what actually pays to repair or replace your vehicle. Collision coverage is exactly what it sounds like. It pays to fix your car if you are in a collision with another object. That could be another car, a telephone pole, a guardrail, a garage door. It doesn't matter who is at fault. If you cause the accident like David did, it pays for your car. If someone hits you and they don't have insurance, it pays for your car. If you hit a patch of black ice and slide into a ditch, it pays for your car. Without collision, in all of those scenarios, you get a check for $0. Comprehensive coverage is a little more confusing, but think of it as everything else coverage. It's for almost any damage that happens to your car that isn't a collision. A tree branch falls on it during a storm? That's comprehensive. A massive hailstorm makes it look like a golf ball? Comprehensive. You're driving down a country road and a deer jumps out in front of you? That's a comprehensive claim. If your car is stolen, vandalized, catches on fire, or gets flooded, all of that is covered by comprehensive. Again, without it, you get a check for $0. So when you uncheck that box online, you're not just saving money. You are voluntarily taking on 100% of the financial risk for your own vehicle. Now you might be thinking, okay, but I own my car outright. It's older, it's not worth that much. Maybe I can still skip it. That's a valid thought, but let's look at the other, even more insidious trap here. If you have a loan on your car or you are leasing it, you don't have a choice. Your lender, the bank that owns the title to your car, requires you to maintain both collision and comprehensive coverage for the life of the loan. It's in the fine print of the contract you signed. Here's the scary part. The online quote tool doesn't know you have a loan. It will happily let you uncheck the boxes and buy that cheap, liability-only policy. You'll get your insurance cards, you'll feel great. But then, a few weeks later, your insurance company sends proof of coverage to your lender. The lender sees you've dropped the required coverage. They will send you a threatening letter first, but what happens next is a financial nightmare. They will use a clause in your contract to force place insurance on your vehicle. This isn't regular insurance. It's an incredibly expensive, lender-specific policy that only protects their interest in the car, not yours. It can be 3, 4, even 5 times more expensive than what you would have paid for normal coverage. And they don't bill you for it. They just add the massive cost directly onto your monthly car loan payment. So your $500 car payment suddenly becomes an $800 car payment, and you're stuck with it. You tried to save $100 and now you're forced to pay $300 extra, all while having terrible coverage. The only time you should ever consider dropping collision and comprehensive is if you own your car outright, and its value is low enough that you could comfortably afford to walk away from it tomorrow and buy another car with cash if it were totaled. If your car is worth $5,000 and you have $5,000 in savings you're willing to spend, then maybe you can self-insure that risk. But if your car is worth $10, $20, or $30,000, skipping this coverage isn't a savvy financial move. It's a reckless gamble. So what's the right way to do it? You keep the coverage, but you manage the cost by choosing the right deductible. A deductible is the amount you agree to pay out of pocket before the insurance company pays the rest. They typically range from $250 to $1,000, or even $2,000. The lower your deductible, the higher your monthly premium. The higher your deductible, the lower your premium. When you're getting that online quote, instead of unchecking the box for collision and comprehensive, click on the deductible amount. See how the price changes when you go from a $500 deductible to a $1,000 deductible. Often that single change can save you $20, $30, or even $40 a month, while still giving you the vital protection you need. You're still covered for that $9,000 repair bill, you just have to pay the first $1,000 instead of the first $500. That's a smart trade-off. You're taking on a small manageable risk, the extra $500, to protect yourself from a catastrophic 5-figure risk. So you've done it. You've avoided mistake number 1. You've kept collision and comprehensive coverage, you've selected a smart deductible, and your car is now fully protected from theft, hail, deer, and your own mistakes. You feel secure. You're ready to buy the policy. But wait, in your haste to protect your car, you've completely ignored the part of the policy that protects everything else you own. Your house, your savings, your investments, your future income. You've just made mistake number 2, and this one won't just cost you your car. Could cost you everything. And it's all hidden in 3 little numbers on your quote that most people think are just a suggestion. Those 3 numbers are your liability limits. They usually look something like this: 25/50/25. It's a simple code for how much your insurance company will pay if you cause an accident. The first number is the maximum they'll pay for a single person's injuries, in thousands. So 25 means $25,000. The second number is the maximum they'll pay for all injuries in a single accident. 50 means $50,000. And the third is the maximum they'll pay for property damage, that's the other person's car, or maybe a mailbox or a storefront you hit. $25,000. Sounds like a lot of money, right? 25,000, 50,000. The online quote tool even presents this as the state minimum. It's the cheapest option. Your brain sees minimum requirement and thinks, great, that's all I need. I'm a safe driver anyway. You click the box, you save $60 a month, and you feel like you just outsmarted the system. But what you've actually done is start a countdown timer on a financial bomb that you've strapped to your own back. Let me tell you about a guy named Mark. Mark is just like you and me. He works hard, pays his bills, he's saving up for a down payment on a bigger house. He's a good driver. No tickets in 10 years. When he bought his new-to-him Toyota Camry, he did the responsible thing and went online to get insurance quotes. He saw the state minimum option, 25/50/25. The price was fantastic. It was almost $100 a month cheaper than the next level up. He thought, why would I pay more? I'm not going to cause a $100,000 accident. He clicked the button. 2 months later, he's driving home from work. It's one of those late autumn evenings where the rain is just a little too cold, and the roads are slick with wet leaves. He's on a 2-lane highway doing the speed limit. A deer darts out from the woods. Mark does what any of us would do. He swerves. For a fraction of a second, his tires lose their grip on the wet pavement. The Camry slides gracefully, almost in slow motion, across the yellow line and directly into the path of an oncoming Ford Explorer. The impact isn't a Hollywood explosion. It's a sickening crunch of metal and a jolt that steals the air from his lungs. When everything stops, Mark is shaken, but he's okay. The airbags worked. He looks over at the other vehicle. Inside is a family of 3. A husband, a wife, and their teenage son in the back. They're dazed but conscious. Everyone seems okay. Frightened but okay. The police come, the ambulance arrives just in case. Reports are filed. It's clearly Mark's fault. He crossed the center line. His Camry is totaled. The Explorer is badly damaged, but it looks reparable. Mark calls his insurance company from the side of the road, and a wave of relief washes over him. This is why he pays for insurance. They'll handle it. The first call comes 3 days later. It's the auto body shop. The Ford Explorer has extensive frame damage and a dozen busted sensors and electronics. It's a total loss. And because it was a high-end trim model from last year, its replacement value is $62,000. Mark thinks, wow, that's a lot, but my insurance will cover it. Then the agent on the phone says the words that make his stomach drop. "Mark, your policy has a property damage limit of $25,000. We've sent them a check for that amount." Mark does the math in his head. 62,000 minus 25,000. He is now personally, legally on the hook for $37,000. Just for the car. He hasn't even heard about the medical bills yet. That call comes the following week. It's not from his insurance company. It's from a lawyer. The driver of the Explorer, the father, suffered a herniated disc in his back during the collision. It wasn't obvious at the scene, but the pain set in over the next 24 hours. He needs surgery. The wife has severe whiplash and will need months of physical therapy. Their initial medical bills have already topped $90,000. Mark's heart is pounding in his chest. He pulls up his insurance policy on his phone. He sees the first two numbers, 25/50th, $25,000 per person, $50,000 total for the entire accident. His insurance company will pay out the full $50,000, but that leaves another $40,000 in medical bills that aren't covered. So now he's on the hook for the $37,000 for the car, plus the $40,000 for the initial medical bills, $77,000. And the lawyer on the phone informs him, that's just the beginning. They are suing him, not just for the car and the current bills but for future medical costs, for the father's lost wages from being unable to work his construction job, and for a little thing called pain and suffering. The total of the lawsuit is $400,000. Mark's insurance company, the one he paid to protect him, sends him a formal letter. It's called a reservation of rights. It basically says, we have paid out the maximum amount defined in your policy, a total of $75,000. We have fulfilled our legal obligation. You are on your own for the rest. $400,000 minus $75,000. Mark is now facing a $325,000 judgment. That's more than his house is worth. The next year of his life is a blur of legal fees, court dates, and stress that ages him a decade. In the end, the court sides with the injured family. Of course they do. Mark's wages are garnished. A lien is placed on his home, meaning he can't sell it or refinance it without paying the judgment first. His savings account, the one for the new house, is drained completely. His retirement accounts are targeted. His entire financial life, every dollar he earned, every sacrifice he made, is systematically dismantled. And it all happened because he tried to save $100 a month. He clicked the state minimum button because he thought he was being smart, but he wasn't buying protection. He was buying a ticket to financial ruin. This story isn't an exaggeration. It happens every single day in America. The cost of everything has exploded, but state minimum insurance laws haven't kept up. $25,000 for property damage? That might not even cover the repair bill for a fender bender on a new Mercedes or a Tesla. The average cost of a new car in the United States is nearly $50,000. If you total someone's brand new pickup truck, your state minimum coverage won't even pay for half of it. And the medical costs? $50,000 for injuries? A single night in the hospital with a few tests can cost more than that. A multi-day stay with surgery can easily run into the hundreds of thousands. You are betting your entire future that you'll only ever get into a tiny accident with an old, cheap car whose occupants have incredible health insurance and don't believe in lawyers. That is a terrible bet to make. So what is the solution? It's shockingly simple. When you're getting that online quote, you need to ignore the state minimum option completely. Think of it as a trap designed for the uninformed. The absolute bare minimum you should consider is what's often called 100/300/100. That's $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. For the vast majority of people, this is a responsible and safe starting point. The price difference per month to go from the pathetic state minimum to this level of real protection is often less than what you'd spend on a few cups of coffee. But we can do even better. The real pro-level move is to match your liability limits to your net worth. If you own a home, have a 401k, and some savings, add it all up. If your net worth is $300,000, you need at least that much in bodily injury liability coverage. Why? Because that's what a lawyer will see when they decide to sue you. They target what you have. Your insurance should be a shield that protects all of it. And that brings us to the single most valuable and underutilized tool in all of personal finance: the umbrella policy. An umbrella policy is an extra layer of liability coverage that sits on top of your auto and home insurance. For a surprisingly low cost, Often just $200 to $300 a year, you can add $1 million or more in protection. If you exceed the limits of your auto insurance like Mark did, the umbrella policy kicks in and covers the rest. $1 million umbrella policy could have saved Mark from financial ruin for less than $1 a day. It is the single best financial decision you can make to protect your family's future. So when you're on that website and you see those 3 little numbers, don't see them as a suggestion. See them as the foundation of your entire financial house. Choosing the state minimum is like building your house on quicksand. You might save a little money on the foundation, but you're just waiting for the day it all gets swallowed whole. You're not just insuring your car. You're insuring your ability to sleep at night. You're insuring your savings, your home, your kids' college fund. And that protection is worth far more than the $60 you thought you were saving. But even with the right liability limits, you could still be one click away from another devastating mistake. This next one involves a feature that sounds like a good thing, a helpful service, until you realize it can leave you stranded on the side of the road with a massive bill, even when the accident isn't your fault. It's called roadside assistance, and it's one of the most deceptively dangerous add-ons you can select when getting an online quote. Feels like a no-brainer. For a few extra dollars a month, sometimes literally the price of a gas station coffee, the insurance company promises to be there for you if you get a flat tire, run out of gas, or your car breaks down. It's marketed as a safety net, a guardian angel you can summon with a single phone call. But for a family from Ohio, let's call them the Millers, this safety net turned into a trap that nearly ruined their lives. The Millers were on the cross-country road trip they'd been dreaming of for years. They'd saved up, planned their route through national parks, and packed their trusted SUV to the brim. 2 weeks into their adventure, driving through a desolate stretch of highway in northern Arizona, the unthinkable happened. The engine sputtered, warning lights flashed across the dashboard like a Christmas tree from hell, and the vehicle coasted to a dead stop on the shoulder. They were miles from the nearest town, with spotty cell service and the sun beating down. But Mr. Miller wasn't panicking. He'd been so proud of himself when he'd gotten his car insurance quote online. He'd seen the little checkbox for roadside assistance, for just $15 every 6 months. He'd thought, what a bargain. He pulled out his insurance card, confidently dialed the 1-800 number, and explained their situation. The operator was polite and reassuring. A tow truck was on its way. The relief that washed over the family was immense. This is why you pay for insurance, they thought. An hour later, a tow truck arrived. The driver hooked up their SUV, and Mr. Miller told him the address of a highly rated dealership in Flagstaff, about 60 miles away, that specialized in their vehicle's make. The tow truck driver just shook his head. Sorry, pal. Your insurance only covers a tow to the nearest approved service center. That center, he explained, was a small independent garage in a tiny town about 12 miles back the way they came. Mr. Miller protested. He'd never heard of that place. He wanted his car taken to a specialist. The driver was sympathetic but firm. My contract with your insurance company is to take you there. If you want to go to Flagstaff, it's covered for the first 15 miles. The remaining 45 miles you'll have to pay out of pocket. At $4 a mile, that'll be an extra $180. Cash. Defeated, they agreed to go to the closer garage. What choice did they have? They were dropped off at a dusty one-bay shop with a hand-painted sign. The mechanic, a gruff man named Sal, said he was swamped. He couldn't even look at their car for at least 2 days. When he finally diagnosed the problem, a complex transmission failure, he said the parts would take another 4 days to arrive. The Millers were stranded. Their meticulously planned vacation itinerary was shattered. They were stuck in a motel with peeling wallpaper, paying for a rental car out of their own pocket because, as they soon discovered, their insurance policy didn't include rental reimbursement unless it was part of a covered collision claim. The final repair bill from Sal was nearly double what the dealership in Flagstaff would have charged. But by then, they were hostages to the situation. That bargain $15 roadside assistance plan ended up costing them over $2,000 in extra repairs, hotel bills, and rental fees, not to mention a week of their dream vacation. The Millers fell victim to what I call mistake number 3, blindly trusting your insurer's roadside assistance. When you're clicking through that online quote form, that little checkbox is designed to be an impulse buy. Cheap, it sounds useful, and it gives you a warm feeling of security. But what the insurance company doesn't advertise in bold letters are the crippling limitations hidden in the fine print. The first trap, which the Millers discovered the hard way, is the nearest approved facility clause. Insurance companies are all about managing costs. They negotiate bulk deals with a network of repair shops. When you break down, they aren't sending you to the best mechanic. They're sending you to the cheapest mechanic who is in their network. This can be a disaster if you drive a European car, a specialized truck, or an electric vehicle that requires specific tools and expertise. Your car could end up at a general garage that has no idea how to properly fix it, leading to more expensive problems down the road. You lose all control, all choice over who touches your vehicle. The second trap is the ridiculously short towing distance. That 15-mile limit the Millers ran into is incredibly common. Some of the cheapest plans only cover 5 or 10 miles. Think about it. If you break down on a major highway between cities, or in a rural or suburban area, the nearest competent mechanic is almost certainly more than 15 miles away. Your trusted mechanic back home? Forget it. You'll be paying a hefty out-of-pocket bill for every single mile over that tiny limit. That $15 add-on suddenly becomes a coupon for a $300 towing bill. The third trap is the fine print on what actually constitutes a service call. Many policies limit you to 3 or 4 calls per year. Let's say you use it once because you locked your keys in the car. You use it again a few months later for a jump start on a cold morning. Then you get a flat tire and need someone to change it. That's 3 calls. The very next week, when your engine blows on the interstate, you might call them only to be told you've exhausted your benefits for the year. You're on your own. So what's the solution? How do you avoid this trap when you're staring at that online quote? First, you have to become a detective. Before you check that box, you must find the link that says View Details or Learn More. Dig into the policy documents. Find the exact towing mileage limit. See if it specifies nearest approved facility, or if it allows you to choose your destination. If you can't find this information easily, that's a massive red flag. It means the company is likely hiding unfavorable terms. But the real solution, the one that provides genuine peace of mind, is to almost always say a no to your insurance company's roadside assistance and instead invest in a dedicated third-party provider. I'm talking about services like AAA or even benefits that come with certain premium credit cards or new car purchases. At first glance, these seem more expensive. A basic AAA membership might cost $60 a year, while your insurer is offering it for $20. But you are not comparing apples to apples. You are comparing a child's toy first aid kit to a paramedic's fully stocked ambulance. A dedicated service like AAA exists for one reason: to provide roadside assistance. It's their entire business model. Their basic plans often start with a significant towing range and go up to 100 or even 200 miles on their premium plans. And crucially, they will almost always tow you to the destination of your choice. To your home, to your trusted family mechanic, to the dealership. You are in control. Furthermore, their benefits extend far beyond a simple tow. They offer trip interruption coverage, which helps pay for hotels and meals if your car breaks down far from home. They offer discounts on hotels, rental cars, and even movie tickets. They can provide locksmith services, battery replacement on the spot, and a host of other benefits that your cheap insurance add-on would never include. When you're getting that online quote, the system is designed to make you feel smart for saving money. Choosing the state minimum liability, skipping rental reimbursement, adding that cheap roadside assistance, it all makes the final price go down. Feels like a win, but what you're really doing is buying a lottery ticket for financial disaster. You're trading real, comprehensive protection for a few dollars a month. That $40 a year you save by choosing the insurer's plan over a dedicated service will evaporate in an instant when you're faced with a single, uncovered $200 tow bill. So the next time you see that checkbox, I want you to think of the Millers, stranded in that dusty Arizona town, watching their dream vacation turn into a financial and logistical nightmare. Resist the urge to click it. Take the 5 extra minutes to research a dedicated roadside plan. It is one of the single best investments you can make for your vehicle and your peace of mind. Making the right choice here is critical, but it pales in comparison to the mistake we're about to cover next. This one has nothing to do with breaking down. It has to do with a perfectly normal, everyday accident, maybe a simple fender bender in a parking lot. But because of 2 little numbers you choose on the quote screen, this minor incident could legally empower the other driver to sue you, garnish your wages, and potentially take everything you own. Those 2 little numbers are your liability limits. And this brings us to the single most financially catastrophic error you can make when buying car insurance online. Mistake number 3, blindly selecting the state minimum coverage just because it's the cheapest option. Let me tell you about a guy named Mark. Mark is a smart guy. He's a software developer, makes a decent living, owns a modest home, and is diligently saving for retirement. He's exactly the kind of person who shops for insurance online to find the best deal. And like millions of others, when he got to the coverage selection page, he saw the state minimum option. It was by far the cheapest. He thought, perfect. I'm a safe driver. I've never been in a serious accident. Why would I pay for more than I'm legally required to have? So he clicked it, paid his premium, and felt good about saving a few $100s a year. 6 months later, Mark was driving home from work. It was raining. He was approaching a red light, maybe going a little too fast for the conditions, and his car hydroplaned. He slid right into the back of a brand new Lexus SUV waiting at the light. It wasn't a high-speed crash. The airbags didn't even deploy. His car had some front-end damage. The Lexus had a crumpled bumper. They exchanged information, the police came, filed a report, and everyone drove away. Mark called his insurance company, filed the claim, and figured his rates would go up, but that was the end of it. He was wrong. A few weeks later, he got a letter. It wasn't from his insurance company. It was from a law firm. The letter stated that the driver of the Lexus, a successful surgeon, was claiming a severe neck and back injury from the jolt of the collision. The letter detailed ongoing physical therapy, lost wages from being unable to perform surgery, and a demand for compensation for pain and suffering. The total demand was $250,000. Mark's stomach dropped. He thought, this is what I have insurance for. He immediately forwarded the letter to his claims adjuster. The adjuster called him back the next day, and the conversation changed Mark's life forever. The adjuster's voice was calm, clinical. He said, Mark, we've reviewed the demand. Based on your policy, we are obligated to defend you and pay up to your coverage limits. Your policy has the state minimum for bodily injury liability, which is $25,000 per person. Mark was silent for a second, trying to process it. Wait, what? $25,000? They're asking for $250,000. The adjuster replied, I understand, sir. We will attempt to negotiate a settlement within your policy limits. But I am legally obligated to inform you that if the other party does not accept a settlement for $25,000, and they pursue a lawsuit and win a judgment for more than that amount, you will be personally responsible for the difference. The difference? The difference was $225,000. This is not a scare tactic. This is the reality of choosing state minimum coverage. You see, the government doesn't set the state minimum to protect you. They set it to provide a tiny, minuscule safety net for the other person you might injure. It's the bare minimum required to legally operate a vehicle on public roads. It is not, in any way, a recommendation for what is financially safe or responsible. Think of it this way. State minimum liability is like the government telling you that you're legally allowed to go into the middle of the ocean with nothing but a child's pool float tie. Can you do it? Yes. Should you? Absolutely not. A real insurance policy is a Coast Guard-approved life raft. Let's break down what these liability limits actually mean. When you see numbers like 25/50/25, here's the code. The first number, 25, is $25,000. That's the maximum amount your insurance will pay for any single person's medical bills and related costs if you cause an accident. The second number, 50, is $50,000. That is the absolute maximum your insurance will pay for all medical-related costs for everyone in the other car, combined for a single accident. If you hit a minivan with a family of 4 and they all get hurt, your policy will only pay out a total of $50,000, no matter how high their collective medical bills are. The third number, 25, is $25,000 for property damage. This covers the cost to repair or replace the other person's car or any other property you damage, like a mailbox or a storefront. Now look at those numbers again. $25,000 for medical bills. Have you seen a hospital bill lately? A single night in the ER after a car accident can easily exceed that. $25,000 for property damage. The average price of a new car in the United States is now over $48,000. If you hit a new Ford F-150, a Tesla, or a Lexus like Mark did, your state minimum coverage won't even be enough to replace their car, let alone pay for their medical bills. So what happened to Mark? The surgeon's lawyer laughed at the $25,000 settlement offer. They went to court. The surgeon had expert medical witnesses, and Mark's insurance company provided a lawyer to defend him, as promised. But the jury sided with the surgeon. They awarded him $200,000. Mark's insurance company paid its maximum, $25,000. Mark was now legally on the hook for the remaining $175,000. He didn't have that kind of money in his bank account, so the court issued a judgment against him. They put a lien on his house. They began garnishing 25% of his paycheck every single week. The retirement fund he had been so carefully building, the court could and did go after that too. That one click, that decision to save a few bucks a month by choosing the state minimum, ended up costing him his financial future. He was trapped in a cycle of debt, all from a rainy day and a seemingly minor fender bender. So what is the solution? It's shockingly simple and inexpensive. When you're on that quote screen, you need to ignore the state minimum option as if it's a trap, because it is. Look for liability limits of at least 100/300/100. Let's translate that. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This is widely considered a responsible baseline for the average person. It provides a much stronger shield between your personal assets and the person you might accidentally harm. And here is the most important part, the secret the insurance industry doesn't shout from the rooftops. The price difference between the pathetic state minimum policy and a robust, protective 100/300/100 policy is often laughably small. We're talking about maybe $10 to $20 a month. That's it. For less than the cost of a few lattes or a Netflix subscription, you increase your bodily injury protection by 400% and your property damage protection by 400%. It is the single highest value purchase you can make in the entire world of insurance. There is no better return on your investment than increasing your liability limits. And if you own a home or have significant savings, you should consider going even higher to 250/500/100, and then adding something called an umbrella policy on top of that, which gives you an extra $1 million or more in liability coverage for both your home and auto. It's a powerful tool for protecting your wealth. So the action item here is clear. After this video, I want you to pull up your own car insurance policy. Find the declarations page. Look for the section on liability and find those three numbers. If they look anything like 25/50/25 or anything close to your state's minimum, your number one priority should be to call your agent or go online and increase them. Right now, it is the most important 5-minute phone call you can make to protect everything you've worked for. Choosing state minimums is like playing a game of financial Russian roulette every single time you get behind the wheel. You might win for a while by saving a few dollars, but when you lose everything. Now, protecting yourself from suing others is one thing. But what happens when the tables are turned? What happens when someone with terrible insurance, or no insurance at all, plows into you and puts you in the hospital? You might assume their lack of responsibility isn't your problem, but you'd be dead wrong. In fact, their mistake can become your financial nightmare, unless you've specifically chosen to protect yourself with two critical coverages that most people getting online quotes either ignore or actively remove to save a few bucks. These two coverages are called uninsured motorist protection and underinsured motorist protection. And they are, without a doubt, two of the most tragically misunderstood and dangerously neglected parts of any auto insurance policy in America. People see them on the quote form, they see that they add $10, $20, maybe $30 to their monthly premium, and they uncheck the box. They think, I'm a safe driver, I don't need that. And in that single click, they expose themselves and their family to total financial ruin. This catastrophic misunderstanding leads us directly to the fourth major mistake people make when getting car insurance quotes online: treating uninsured and underinsured motorist coverage as an optional luxury instead of a non-negotiable shield for your life and your finances. Let's break this down, because understanding this could be the single most important financial lesson you learn this year. First, uninsured motorist coverage. The name is pretty self-explanatory. It protects you when you are hit by a driver who has no insurance at all. You might think, well, that's rare, right? Everyone has to have insurance. Wrong. The Insurance Research Council estimates that 1 in every 8 drivers on the road is uninsured. 1 in 8. In some states like Mississippi and Florida, it's closer to 1 in 4. Think about that. On your daily commute, you will pass dozens, if not hundreds, of drivers who have zero ability to pay for the damage they might cause. So let's play out the scenario. You're sitting at a red light, minding your own business. Suddenly, you feel a violent jolt. You're thrown forward. Your car is smashed from behind. The other driver gets out, they're apologetic, but they don't have an insurance card. They don't have a policy. They were driving a friend's car. or they let their coverage lapse, or they just decided to risk it. Now what? Your car needs thousands in repairs. Your neck is in searing pain and you need to go to the emergency room. Who pays for that? The at-fault driver? You can try. You can sue them in civil court. But let me ask you a question. If a person can't afford a basic car insurance policy, what are the odds they have $10,000, $50,000, or $100,000 in assets for you to claim in a lawsuit? The odds are virtually zero. You will win a piece of paper, a judgment that is completely worthless. So you are left holding the bag. You'll pay your own collision deductible to fix your car, and your health insurance will be on the hook for your medical bills, leaving you to pay your high deductible and copays. And what about the wages you lose from being out of work? What about the pain and suffering from the injury itself? You get nothing. Absolutely nothing. Unless you have uninsured motorist bodily injury coverage. With this coverage, your own insurance company steps into the shoes of the uninsured driver and pays you for everything you would have been entitled to. They pay your medical bills. They pay for your lost income. They compensate you for your pain and suffering, up to the limits you selected. It is your financial lifeboat. It's the hero that swoops in to save you from the irresponsibility of a complete stranger. Now that's the easy one to understand. The far more common and far more insidious danger is the underinsured driver. This is where the real nightmare begins for most people. An underinsured driver isn't breaking the law. They have insurance, but they have the bare minimum amount required by the state. And this is where people get a false sense of security. They think, well, if the other guy has insurance, I'm covered. Oh, if only it were that simple. Let's look at what state minimum actually means. In a state like Florida, the minimum bodily injury liability a driver is required to carry is just $10,000 per person. In California, it's $15,000. In Pennsylvania, it's $15,000. Let me put that into perspective. A single ambulance ride and an ER visit with a CT scan can easily exceed $10,000. A one-night stay in a hospital can be $10,000. A simple surgery on a broken bone can be $20,000, $30,000, $50,000 or more. That state minimum coverage is exhausted before you've even been discharged from the hospital. Let's create a real-world story. Meet Jessica. She's a 35-year-old graphic designer, a responsible driver, has good health insurance through her job, and she's driving home from work. A college kid, distracted by his phone, runs a stop sign and T-bones her car. The crash is severe. Jessica suffers a broken femur and a concussion. The college kid is clearly at fault. He has insurance, the state minimum, which in his state is $25,000 for bodily injury. Now let's follow the money. The ambulance ride is $2,000. The emergency room visit is $8,000. The surgery to put a rod in her leg is $45,000. 2 days of hospital recovery are another $15,000. Physical therapy will be $10,000 over the next 6 months. We are already at $80,000 in medical bills. And Jessica is out of work for 3 months, losing another $15,000 in income. Her total economic damages are $95,000. The college kid's insurance company is very polite. They promptly send a check for $25,000, the full limit of their policy. And that's it. They are legally done. They have fulfilled their obligation. So where does the other $70,000 come from? Jessica's health insurance will cover a large portion of the medical bills, sure. But she has a $5,000 deductible and a 20% coinsurance, meaning she's still on the hook for thousands upon thousands of dollars out of her own pocket. And what about her $15,000 in lost wages? Health insurance doesn't cover that. What about compensation for the fact that she now has a metal rod in her leg for life and walks with a slight limp? You get nothing for that. The at-fault driver's pathetic policy has left her financially crippled. This is the exact scenario that underinsured motorist coverage, or UIM, was designed to prevent. If Jessica had selected a UIM limit of, say, $250,000 on her own policy, her insurance company would have stepped in right where the college kids left off. After his policy paid its $25,000, her UIM coverage would kick in to cover the rest. It would pay the remaining medical bills. It would reimburse her for her lost wages. It would provide compensation for her pain, her suffering, and her permanent injury. It would make her whole again. It bridges the gap between the other driver's inadequate coverage and your actual damages. When you're online clicking through a quote, the system is designed to get you to the lowest price. It will default to low limits or even leave UM and UIM unchecked. You see that line item and think you're saving money by removing it. You are not. You are gambling your entire financial future to save the cost of a few cups of coffee a month. You are not insuring yourself against your own mistakes. You are insuring yourself against the catastrophic and statistically probable mistake of someone else. And here's a pro tip most online forms will never explain. In many states, you can choose to stack your uninsured and underinsured motorist coverage. If you have 2 cars on your policy and you have $100,000 of UIM on each, stacking allows you to combine those limits, giving you $200,000 of protection in a single accident. It's an incredibly powerful multiplier for your safety net, often for a very small additional cost. So when you're getting that quote, I want you to look at those liability limits you chose for yourself, that 100/300/100 we talked about earlier. As a rule of thumb, you should have at least that same amount in uninsured and underinsured motorist coverage. You are protecting your own body and your own finances with the same level of respect you're legally required to show a stranger. Your liability coverage protects your assets when you cause an accident. Uninsured and underinsured motorist coverage protects your life when someone else does. Don't ever let a website convince you to uncheck that box. Protecting yourself from other drivers is one half of the equation. But what about the immediate out-of-pocket costs from an accident, regardless of who's at fault? The ambulance ride, the ER visit, the health insurance deductible. These can hit your bank account before the insurance companies have even decided who to blame. And that brings us to the 5th and final mistake, a mistake that leaves you paying thousands out of pocket, even when you thought you had full coverage. And that mistake is trusting the term full coverage. It's one of the most misleading phrases in the entire insurance industry. There is no legal definition, no industry standard for what full coverage actually means. When you click that button online, it usually just means you're getting the bare minimum trio: liability, collision, and comprehensive. But the devil and the potential for financial ruin is in the details of those coverages, specifically your liability limits. Choosing the wrong limits is like building a beautiful, strong house but leaving the front door wide open for burglars. Let me tell you about a guy named Mark. Mark is the kind of person we all know. He's a good guy. He's in his mid-30s, has a decent job, owns a small home in the suburbs, and has about $40,000 socked away in a 401k and some savings. He's responsible. When he went online to get his car insurance quote, he did what he thought was smart. He wanted to save a little money. He saw the different options for liability coverage, and one of them was labeled state minimum. And he thought, well, if it's the legal requirements set by the state, it must be adequate, right? It must be enough. So he clicked the box. The price dropped by about $25 a month. He felt like he just got a great deal. He thought he was fully covered. He was wrong. 6 months later, Mark was driving home from work on a rainy Tuesday. Traffic was heavy. He was listening to a podcast, maybe thinking about what to make for dinner. He was only going about 30 miles an hour when the cars ahead of him suddenly stopped. He hit the brakes, but the wet pavement caused his tires to skid for just a moment. It wasn't a dramatic, movie-style crash. It was a dull, sickening thud as his front bumper connected with the back of the brand-new Lexus SUV in front of him. Everyone was okay. Shaken up, but okay. They pulled over, exchanged insurance information. The driver of the Lexus was a bit annoyed, but polite. Mark looked at the damage. His own car had a crumpled hood. The Lexus had a dented bumper and a cracked taillight. Mark thought, okay, this is a hassle. This is exactly why I pay for insurance. They'll handle it. The first shock came a week later. The repair estimate for the Lexus came in $17,000. It turned out the bumper was packed with sensitive parking sensors, a backup camera, and blind spot monitoring radar. What looked like a simple piece of plastic was actually a complex piece of technology. Mark's state minimum property damage limit was $10,000. That was the maximum his insurance would pay to repair the other person's car. Instantly, Mark was personally on the hook for the remaining $7,000. He had to pull that money from his emergency savings, and it hurt. But he thought the worst was over. The real nightmare started a month after that. He received a thick envelope in the mail. It was from a law firm. The driver and the passenger of the Lexus were now claiming severe neck and back injuries, whiplash. They were seeking damages for medical bills, physical therapy, lost wages, and pain and suffering. The total demand was $150,000. Mark's jaw dropped. He called his insurance company, his voice trembling. They were calm. They told him not to worry, they would handle it. And they did. They paid out the maximum amount his policy allowed for bodily injury. His state minimum coverage was $25,000 per person and $50,000 per accident. So his insurance company wrote a check for $50,000. But that left a $100,000 shortfall. $100,000 that the other party's lawyer was now demanding directly from Mark. His entire life was turned upside down. His savings were gone. The lawyers put a lien on his house. They initiated a process to garnish his wages, meaning a chunk of his paycheck would be taken every single month for years, maybe even a decade, to pay off a debt from a 2-second lapse in concentration on a rainy Tuesday. Mark, the responsible guy, the homeowner, the saver, was facing financial ruin. All to save $25 a month. Mark's story isn't an exaggeration. It happens every single day in this country. And it happens because people don't understand what those numbers on the quote page actually mean. So let's break it down right now so this never happens to you. Liability coverage is split into two main parts: bodily injury or BI and property damage or PD. You'll see it written as a series of 3 numbers, like 25/50/10. The first 2 numbers are for bodily injury. The first number is the maximum amount your insurance will pay for a single person's injuries in an accident you cause. In Mark's case, this was $25,000. The second number is the maximum total amount your insurance will pay for everyone's injuries in a single accident. For Mark, this was $50,000. Now think about that. $25,000. Have you seen a hospital bill lately? An ambulance ride alone can be $2,000. An ER visit with a CT scan can easily top $10,000. If someone needs surgery or ongoing physical therapy, that $25,000 limit is gone in an instant. And if you injure 2 or 3 people, that $50,000 total per accident is a drop in the bucket. You are personally responsible for every single dollar above those limits. The third number is for property damage. This is the maximum your policy will pay for any property you damage in an accident. For Mark, this was $10,000. He hit one Lexus and it wasn't enough. What if he had swerved and hit 2 cars? Or skidded off the road and taken out a $50,000 utility pole? Or crashed into the side of a building? His policy would pay the first $10,000, and he'd be getting a bill for the rest. The state minimums are a trap. They were often set 30 or 40 years ago, and have never been updated to reflect the modern cost of healthcare or vehicle repair. The state isn't recommending these levels. They are simply setting the absolute lowest legal bar to operate a vehicle. Following the state minimum is like a doctor telling you the minimum number of calories to eat to not literally starve to death. It's not a healthy recommendation for thriving. It's the bare minimum for survival. So how much do you actually need? The rule of thumb is simple and powerful. You need enough liability insurance to protect your assets. Think about everything you own. Your home equity, your savings, your investments, your future earnings. That is what a lawyer can and will come after if your insurance isn't enough to cover the damages you cause. Your liability coverage is a shield that stands between a car accident and your entire financial life. For the vast majority of people, I would consider a policy with limits of 100/300/100 to be the bare minimum you should even consider. That means $100,000 for bodily injury per person, $300,000 total per accident, and $100,000 for property damage. This provides a solid layer of protection that will cover the costs of the vast majority of accidents. It protects a modest home, some savings, and your future income from being garnished. If you are a homeowner, if you have a 401k, or any significant savings or investments, you should be looking at limits of $250,000/500/100. That's $250,000 per person, $500,000 per accident. This is the level of protection that lets you sleep at night, knowing that one bad moment on the road won't unravel everything you've worked so hard to build. Now I know what you're thinking. That sounds expensive. The amazing part is it's not. The price difference between state minimum and a truly protective 100/300/100 policy is often shockingly small. We're talking maybe $15 to $30 a month. It is the single best investment you can possibly make. You're paying a few extra dollars to protect yourself from a potential $100,000, $200,000, or even larger lawsuit. And for those with a higher net worth, you should absolutely ask about an umbrella policy. This is a separate insurance policy that kicks in after your auto and home liability limits are maxed out, providing an extra $1, $2, or even $5 million of coverage. They are incredibly cheap for the peace of mind they provide. So when you're getting that online quote, do not just click state minimum. Do not just assume full coverage has you covered. Go into the liability section and manually select higher limits. Select 100/300/100 as your starting point. Price it out. Then price out 250/500/100. See what the difference is. I promise you that extra $20 a month will feel like nothing compared to the peace of mind of knowing your life savings are protected by a real shield, not a piece of cardboard. Now that you know exactly what coverages to look for and how to protect your financial future, how do you actually find the best price without getting spammed or wasting hours of your time? The truth is, the way most people compare quotes online is completely backward, and it's costing them hundreds of dollars. In the next part, I'm going to show you the 3-quote method that forces companies to compete for your business and reveals the hidden winner you would have otherwise missed. So let's break down this 3-quote method. It's not just about getting 3 random prices. It's a strategic system designed to reveal the entire market landscape. From the giants you see on TV every 10 minutes to the hidden players who don't spend $1 billion on advertising. Each quote has a specific purpose. Think of it like a 3-round championship fight for your business. Round 1 is what I call the loyalty check. Your first quote must always come from your current insurance company. Now I know what you're thinking. Why would I start with them? I'm trying to leave. That's the mistake. You don't start with them because you're loyal. You start with them to establish a baseline. You need to know the absolute best price they are willing to offer to keep you. This is crucial. Don't just look at your renewal notice. That's a passive price they hope you'll pay without thinking. You need to call them. Yes, pick up the phone. This isn't a task for an online form. When you get a person on the line, you say these words or something very close. Hi, my renewal is coming up, and I'm actively shopping for new insurance quotes to make sure I'm getting the best possible rate. I've been a customer for X years and I prefer to stay, but it has to make financial sense. Before I spend my afternoon getting quotes from your competitors, I need to know, what is the absolute best, rock bottom price you can offer me to keep my business? The psychology of this phrase is powerful. You've signaled 3 things immediately. 1. You are not a passive customer accepting a renewal. You are an active shopper. 2. You've reminded them of your tenure, triggering their customer retention protocols. And 3. You framed it as a competition, giving them one last chance to win before the game even starts. You will be amazed at what happens next. Suddenly, they'll want to do a policy review. They'll discover discounts you magically qualify for now that you were never offered before. A good student discount for your kid that was overlooked. A new discount for bundling that just became available. A lower rate because you've been accident-free. This isn't magic. It's the retention department discount. They have discretionary power to keep customers from leaving, but they will never use it unless you force their hand. The price they give you after this call is your official round 1 benchmark. This is the number to beat. Now we move to round 2. The National Gauntlet. This is where you go directly to the behemoths. The Geicos, the Progressives, the Allstates, the State Farms, the companies with blimps and funny commercials. You're going to pick 2 or 3 of the biggest names and get quotes directly from their websites. This step is critical because these companies operate on massive scale. Sometimes their sheer size allows them to offer rates that no one else can touch. But this is also where mistake number 3, which we talked about earlier, can ambush you: the apples to oranges comparison. When you fill out these online forms, you must be meticulous. Have your current policy's declaration page right in front of you. You are going to input the exact same liability limits: 100,000, 300,000, 100,000. You're going to select the exact same comprehensive and collision deductibles: $500, $1,000. You will match the rental reimbursement and roadside assistance coverage to the dollar. Do not let their website default you to a lower state minimum coverage just to show you a shockingly low price. That's a trap. The goal of round 2 is to get a true, apples-to-apples price from the biggest national players. Can their massive scale and advertising budget beat your current company's best retention offer? Sometimes the answer is a resounding yes. You might find a quote that's hundreds of dollars cheaper for the identical coverage. That becomes your new number to beat. But this is where most people stop. They find a cheaper quote from a big company and they switch. Big mistake. They've fought the first 2 rounds, but they're walking out of the ring before the final, most important round. Round 3 is your secret weapon. I call it the independent offensive. You are now going to contact an independent insurance agent. This is the part of the strategy that most people have never even heard of, and it is hands down the most powerful way to save money. Let's be crystal clear about what an independent agent is. The agent from State Farm or Farmers. They are called captive agents. They work for one company, and they can only sell you that one company's products. They are a retail store that only sells one brand. An independent agent, on the other hand, works for you. They are contracted with dozens of different insurance companies. Big ones, small ones, regional companies you've never heard of like Erie Insurance or Auto Owners or Acuity. These are fantastic, highly rated companies that don't spend $1 billion a year on TV ads, so they can often pass those savings on to you. When you go to an independent agent, you are not getting one quote. You are getting one person to go out and get 10, 15, even 20 quotes on your behalf. You fill out one application, have one conversation, and they do all the legwork. They plug your information into their system, and it instantly shops you across their entire portfolio of carriers to find the best possible match for your specific situation. Maybe one of their carriers specializes in drivers with a less than perfect record. Maybe another gives a massive discount for your specific profession. You would never find these companies on your own. You would never even know to look for them. The independent agent is your professional guide to this hidden market. They know which companies have the most competitive rates in your zip code right now because these things change constantly. A company that was expensive last year might be aggressively trying to gain market share this year, offering incredibly low rates to do it. The independent agent knows this. You don't. They are your insider. So you give the independent agent your benchmark price, the lowest number you got from round 1 and round 2. You tell them, this is the number to beat for this exact coverage. This turns them into your personal shopper, motivated to scour their network to find a policy that saves you money, because that's how they earn your business. And then comes the final showdown. You've let the market compete for you. You have 3 key data points. First, your current company's best possible retention offer. Second, the best price from the massive national players. And third, the best price uncovered by your independent agent, pulled from a pool of dozens of hidden gem companies. Now, and only now, are you in a position of power. You can see the entire landscape. Maybe Progressive came in lowest. Maybe your current company, faced with true competition, actually gave you a great deal. Or, in many cases, the independent agent will come back with a quote from a company you've never heard of that blows everyone else out of the water. This is the hidden winner. This is the company you would have never found if you had just plugged your info into a few of the big-name websites and called it a day. You forced the entire market to compete, from the giants to the specialists, and you've done it with just 3 strategic steps. This method turns a frustrating chore into a predictable system that puts you in complete control. It ensures you're not just getting a cheaper price, you're getting the right price. But that brings us to the final, and by far the most catastrophic mistake people make. It's the one that happens at the very end of the process, right at the finish line, after you found what you believe is the perfect quote. It's the mistake that can turn a $500 savings into a $10,000 nightmare. And that is mistake number 5. Assuming that 2 policies with the same liability limits are the same policy. Let me say that again because it is the most important sentence you will hear in this entire video. Assuming that 2 policies with the same liability limits are the same policy. You see, we've been trained to shop for insurance like we shop for gasoline. We see the price per gallon, we see the octane rating 87, 89, 93, and we assume that 87 octane at Shell is the same as 87 octane at BP. For the most part, it is. Car insurance is the complete opposite. Comparing 2 insurance policies based on their liability limits, say 100,000, 300,000, 100,000, is like comparing 2 houses based only on the fact that they both have 3 bedrooms. It tells you nothing about the foundation, the quality of the plumbing, the age of the roof, or whether the electrical system is a fire hazard. The liability limits are just the label on the box. The real value, the real protection, is what's written in the fine print inside. And this is where cheap insurance companies make a killing. They give you the same shiny label as the premium carriers, but they've systematically hollowed out the actual product inside. Let me tell you a story about a guy named David. David was meticulous. He followed all the steps. He got multiple quotes, he negotiated, and he found a policy with a new, online-only insurance company that saved him $60 a month. He was ecstatic. He had the exact same 250/500/100 liability limits as his old, expensive policy. He felt like he'd cracked the code. 6 months later, a driver runs a red light and T-bones his brand new SUV. The car is badly damaged, but thankfully everyone is okay. David's car is undrivable and needs to go to the body shop for at least 3 weeks. No problem, David thinks. I have rental car coverage. He calls his new, super cheap insurance company. The agent on the phone is polite and says, "Of course, Mr. Johnson. Your policy includes rental reimbursement." David breathes a sigh of relief. Then the agent continues, "We can reimburse you up to $25 per day, with a maximum of $750 for the entire claim." David's heart sinks. He gets on Expedia and Enterprise, the cheapest available rental car. A tiny compact he can barely fit his kids into is $70 a day. His 3-week repair is going to cost him nearly $1,500 in rental fees. His insurance, the one he was so proud of, will only cover half of that. His $60 a month savings just got vaporized by a $750 out-of-pocket expense he never saw coming. And that was just the first domino to fall. The body shop calls him a week later. "Mr. Johnson, your insurance company has only approved the use of aftermarket and reconditioned parts for your repair. Your SUV is only a year old. We strongly recommend using original equipment manufacturer, or OEM, parts to maintain the vehicle's safety standards and resale value." David calls his insurer furious, and they calmly refer him to page 27, subsection C of his policy document, which clearly states they reserve the right to use non-OEM parts. The cost to upgrade to the factory parts his car was actually built with? Another $2,000 out of his pocket. In the span of 2 weeks, David's great deal on insurance cost him nearly $3,000. He saved $360 in 6 months, only to spend nearly 10 times that amount when he actually needed the policy to work. He didn't buy bad insurance. He bought an illusion. He bought the label on the box, but he never bothered to check what was inside. David's story is the critical lesson. The price of the policy is irrelevant until you understand the value it provides. So before you ever click buy on a new policy, you have to become a detective. You need to get a copy of the actual policy jacket, or a specimen policy, a sample of the full contract. And you need to look for these specific, non-negotiable clauses. First is rental reimbursement. Don't just check the box. Find the numbers. What is the per day limit, and what is the total maximum? A $25 a day limit is useless in today's market. You should be looking for a minimum of $50 or $60 a day to be safe. Second, and this is a massive one, is the parts policy. Search the document for the words original equipment manufacturer, OEM, aftermarket, and like, kind, and quality. Cheaper policies will almost always default to the cheapest possible parts. A good policy will guarantee OEM parts for cars that are newer, usually within the first 2 or 3 model years. This single clause can be worth thousands of dollars in resale value and peace of mind. Third, look at roadside assistance. Is it a full-service program? Or is it just a basic reimbursement? Some policies will only tow you to the nearest repair facility, not your trusted mechanic 5 miles further down the road. That's a huge difference when you're stranded on the side of a highway. Fourth, understand the rules around custom equipment. If you've put in a new sound system, new wheels, or a roof rack, a standard policy will not cover them. You need a specific custom parts and equipment endorsement. If you don't see it listed, that $10,000 audio system you installed is worth $0 to your insurer. And finally, the most dangerous clause of all. Check for a named driver-only policy. Some of the absolute cheapest, bare-bones policies will only cover the specific drivers listed on the policy. This means if you let your brother, your friend, or your neighbor borrow your car for an emergency, and they get into an accident, there is zero coverage. The insurance company will wash their hands of the entire incident, and you will be personally on the hook for all the damages. It's a catastrophic risk just to save a few extra dollars. You don't need to read all 100 pages of the policy document, but you do need to use the search function, Control F on a PC, Command F on a Mac, and look for these key phrases. Scrutinize the details. Compare the value, not just the price. The difference between a great policy and a cheap policy is rarely more than $15 or $20 a month. But as David learned, the difference in outcome during a claim can be thousands, or even tens of thousands of dollars. The entire purpose of insurance is to handle the worst-case scenario. Skimping on the details is like buying a life raft with a slow leak just because it was on sale. It completely defeats the purpose. Getting the right coverage isn't an expense. It's an investment in your financial armor. And that brings us to the fifth and final mistake, which is arguably the most dangerous of all because it happens after you've done everything else right. You've assessed your liability, you've chosen a smart deductible, you've considered the extra coverages, and you've been brutally honest with your details. You run the quotes, and one company comes back significantly cheaper than all the others. Feels like you've hit the jackpot. This is mistake number 5. Ignoring the company's reputation and the policy's fine print. Getting a cheap quote is not the same as getting good value. The true test of an insurance company isn't how smoothly they take your money. It's how they behave when you desperately need them to give it back. Let me tell you about a guy named Mark. Mark was a savvy shopper. He comparison shopped for everything. When it came to car insurance, he found a lesser-known company online that beat the big names by $30 a month. That's $360 a year. He thought he'd outsmarted the system. He clicked buy, got his proof of insurance and didn't think about it again. 6 months later, a driver ran a red light and T-boned his car. The other driver was clearly at fault, but they were uninsured. No problem, Mark thought. This is exactly why I have uninsured motorist coverage. He called his bargain insurance company to start the claim. And that's when his nightmare began. The phone rang for 20 minutes before anyone picked up. When they did, the agent was unhelpful and seemed completely overwhelmed. Getting a rental car, which his policy supposedly covered, took a week of constant, frustrating phone calls. The adjuster assigned to his case was impossible to reach. Weeks turned into a month, then 2. The company lowballed the repair estimate, refusing to approve the use of original manufacturer parts, forcing him to fight with the body shop. Every step of the process was a battle. The $360 he saved felt like a cruel joke compared to the hours of stress, the lost time from work, and the sheer emotional drain of fighting the one company that was supposed to be on his side. Mark's story is a cautionary tale. The quote you see online is just an advertisement. The policy document is the legally binding contract, and the company's reputation is the predictor of how they'll honor that contract. You absolutely must investigate both before you commit. First, let's talk about reputation. Before you buy from any insurer, especially one you're not familiar with, you need to do a 15-minute background check. Think of it like looking up restaurant reviews before a big anniversary dinner. You wouldn't just pick the cheapest one, right? You want to know if the food is good and the service is reliable. For insurance, your review sites are organizations like J.D. Power, which publishes annual ratings on claim satisfaction and customer service. Look up the company you're considering. How do they rank? Another critical one is AM Best. They don't rate customer service. They rate financial stability. They give companies a letter grade like in school. You want a company with an A rating. This tells you they have the financial horsepower to pay out on a large number of claims, even in a major catastrophe. A cheap policy from a company with a C rating is a gamble you can't afford to take. Finally, check the Better Business Bureau and Consumer Complaint Indexes. Are there patterns of bad behavior? A few grumpy reviews are normal for any business, but if you see page after page of people telling a story just like Mark's, run the other way. Second, the fine print. I know nobody wants to read a 40-page legal document, but you don't have to read every single word. You need to strategically scan for the most important parts. When you get your final quote documents before you pay, look for the exclusions section. This is where the insurance company lists everything they will not cover. Are you a delivery driver for a food app? Many personal auto policies explicitly exclude coverage for commercial use. That cheap policy is worthless the second you're on a delivery. Do you customize your car? Many policies have a low limit, like $1,000, for custom parts and equipment unless you buy a special endorsement. That $5,000 sound system you installed? It might not be covered. Also, check the definitions. How do they define uninsured motorist? How do they define vandalism? What are the specific rules for filing a claim? How long do you have to report an accident? Knowledge is power, and in this case, it's also financial protection. Taking 30 minutes to understand the contract you're about to sign can save you $30,000 and months of heartache down the road. Choosing an insurer based on price alone is like choosing a surgeon based on who has the cheapest scalpel. It's the skill, reliability, and track record of the person or company wielding the tool that truly matters. So let's bring this all home. We've journeyed through the 5 most common and costly mistakes people make when getting car insurance quotes online. First, underestimating your liability needs, leaving your entire net worth exposed for the sake of saving a few bucks a month. Second, setting your deductibles too high to chase a low premium, creating a financial barrier that could stop you from even using your insurance when you need it. Third, automatically declining optional coverages like rental reimbursement or uninsured motorist protection, ignoring the small investments that provide massive peace of mind and practical help in a crisis. Fourth, rushing through the details and providing inaccurate information, which can lead to your rate being jacked up later or, even worse, your claim being denied for misrepresentation. And fifth, being seduced by a low price while ignoring the company's reputation and the policy's fine print. Essentially buying a lottery ticket instead of a safety net. The common thread through all of these mistakes is a simple misunderstanding of what car insurance truly is. We've been conditioned to see it as a mandatory, annoying expense, a tax on driving. But that's the wrong frame. Car insurance is not a bill. It is a tool. It is one of the most powerful financial shields you will ever own. It's the invisible bodyguard for your savings account, your home, your future earnings, and your family's stability. When you shop for it, you're not just trying to get the lowest price. You are hiring a financial first responder. You are building a wall around everything you've worked for. So here is your call to action. Your homework if you choose to accept it. Sometime in the next week, I want you to block out 1 hour. No distractions. In the first 15 minutes, pull out your current car insurance policy. Look at your liability limits. Are they enough to protect your assets? Look at your deductibles. Could you write a check for that amount today without flinching? See what optional coverages you have or don't have. Then, for the next 45 minutes, I want you to go online and get at least 3 new quotes. But this time, you're going to do it differently. You're going to be an active, educated consumer, not a passive price shopper. You will use the knowledge from this video. You'll experiment with different liability limits and see how it affects the price. You'll play with the deductibles to find your personal sweet spot between premium savings and out-of-pocket risk. You will be ruthlessly accurate with every detail about your driving habits and your vehicle. And when you get those quotes, you won't just look at the final number. You'll take that extra 15 minutes to do a background check on the top contenders. You'll look them up on J.D. Power. You'll check their financial rating. You will become the chief financial officer of your own life, making a strategic decision, not just a cheap one. By doing this, you transform a chore into an act of empowerment. You are no longer just a driver paying a bill. You are an architect designing your own financial security. The world of insurance can feel complicated and opaque, but it doesn't have to be. By avoiding these 5 mistakes, you are stepping into the top 10% of informed consumers. You are in the driver's seat, not just of your car, but of your financial protection. Thank you for investing your time with me today. Drive safe, shop smart, and stay protected.